You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? This is Mike from The Moose and the Loose. I hope you're doing well on this Tuesday. I got that question several times where when I speak about a stock that I really like, that is one of my largest holdings, and then investors are like, is there a moment where you think you're going to ever sell those favorite stocks? And I started to think about how I would use that process and communicate it to you guys to help you determine when is the right time to sell a company that you really like, and most likely a company that is doing well. So not talking about selling a loser, but rather selling a business that has been thriving, has been good for your portfolio, generating a lot of total return, a lot of dividends, and then one day things change, unfortunately, and when is the right time, how to draw that line and say, you know what, I have to let it go. So what I thought is I would discuss today my 5 largest Canadian holdings. So I'm not talking about the US one, just because I want to keep this show as a Canadian oriented podcast. So just wanted to give you some thoughts on how I would approach this later down the road. So second largest holding across all my portfolio. Big surprise here, Alimentation Couche-Tard. I'm pretty sure that you're getting tired of hearing about this one, but I'm not gonna tell you what is amazing about it today, but rather what would make me sell. So in general, what would make me sell are like 3 simple rules. The first one, if there's a dividend cut. So of course, now we're talking about companies that are thriving. So chances to see ATD cutting their dividend next year, pretty slim. I mean, it's not impossible, but probably not going to be the reason why I'm going to sell this favorite stock. The second reason is if my investment thesis does not match the current situation anymore, or does not match the financial metrics. And this is probably a moment where it could happen with Couche-Tard. So right now, the business continues to thrive. It had 2 bad quarters, but overall still shows a very solid dividend triangle. My investment thesis about their growth vectors and how they plan to expand their business and generate more revenue, profits, and dividend in the future still holds, still makes sense. But maybe, I don't know, like 5 years, 10 years down the road, the company will not find any other convenience stores to buy and will stop growing by acquisition, or will rarely acquire a convenience stores chain. Another thing would be, well, what's going to happen with fuel, right? So if consumers are moving towards electric cars, how they're going to adapt and compensate for the loss of fuel cells. So the company at that point would show a slowing down dividend triangle. Revenue and earnings would probably grow mid-single digit, low single digit, becoming a more mature business. And while the dividend will keep on increasing, the yield will also follow. So all of those signs will probably push me to say, you know what, now it's time to sell, because the investment thesis is not aligned with what I thought it would, like what it was when I bought the stock. So maybe it's going to continue to be a pretty solid consumer staple stock, but more stable, more mature, and just providing a good income. But this is not what I want in my portfolio. So at that time, I would pull the plug. Another one in my portfolio is National Bank. Number 4. Of my largest holdings. National Bank, similar story. Small bank, grow by acquisition, a lot of diversification in the revenue source. So what I'm thinking is if they start struggling with their US and international segment, for example, or if capital markets are not generating the strong profit they are right now and they're not growing anymore, those could be the reasons why I would consider selling National Bank. Again, I don't think they're going to cut their dividend. Maybe I'm going to trim it. So that's like the real rule number 3. So as you can see, I have 3 rules, super simple. Dividend cut, investment thesis, and then trimming for portfolio management. So Large exposure to a sector, large exposure to a stock. So I've trimmed Couche-Tard in the past. I've trimmed Apple and Microsoft several times in the past because they outperformed not only the market, but also the rest of my portfolio. So they became too important. I might have to trim Couche-Tard in the future again. National Bank, I'm not there yet, so I can continue to ride the stock for a while. So I guess that if they have problems with some of their business their business segment, or if they're getting like hurt by any other like mortgage crisis and stuff like that, if it's like a major blow that they will have a hard time to recover, I may start selling a little bit more of my position, because those are like really large holdings in my portfolio, and may bring them down back to a normal position, such as like a 3% weight instead of like 4 or 5% that it could be right now for National Bank. So that is like more on like trimming down a part of it first, and then maybe eventually just say, you know what, the dividend triangle is not strong enough and it's time to let it go. The number 6 on my list is Constellation Software. Ironically, it didn't start there, but the company almost doubled in value since I bought it. So of course it grew rapidly in my portfolio, and now it's like my 6th largest holding. Kind of ironic, because this one is not a dividend grower, but it shows a very solid dividend triangle besides the dividend payments. So a lot of revenue growth, a lot of earning growth. Actually, if you look at cash flow, it's growing very fast. What I like about this business is they operate always the same playbook about growth by acquisition, and they have like a huge pipeline over there, but they don't get into much debt. They're actually just using their cash flow to buy more small companies that are like, and they create all of those software verticals, and they just help those businesses to grow even faster, and it works very well. So I'm thinking, the day that they're going to slow down their growth by acquisition strategy, the day that their pipeline is going to get dry and they're going to literally show a slowdown in this, then my investment thesis will not be as strong. And then I would not mind starting to sell some shares, because I'm already making a lot of profit. So sitting number 6 largest position out of like roughly 35 stocks, still not too exposed to this company, not too exposed to the tech sector, so I'm still comfortable with that. So it will be just to see if their intention is, oh, now we have to overpay for companies, or we don't find any companies that meets our criteria anymore. Fortunately, it's very far from being the case right now, so I'm not too worried. Brookfield Corporation, number 7 in my largest holdings. This one is tricky, because I really like the fact that I have an alternative asset manager in my portfolio. I like their diversification. I like the fact that they are asset heavy, so they invest their own money in their projects, so they can make money on fees they charge other investors. They invest with them, or they can make also money by selling their assets and generating a profit. So this one is really great, but it's quite complex. Their financial structure is opaque, and this could lead me to a quick sell if there's any problems related to that opaqueness. So far, so good. I mean, yes, it's hard to fully analyze this stock, but when you look at other metrics that are easy to track, such as the way they increase their dividend every year, that plus the fact that they've been running the same playbook in the same business for several years as well, and they went through multiple crises without being hurt, I'm not too worried at this point, but I always monitor it quarterly just to make sure that there's not some red flags popping up due to that complex financial structure. It is a risk, but I'm willing to take it. The last one, number 9 on my largest holding, is Telus. Actually, it was higher. So like it did the opposite than Constellation Software. This one is losing steam. So it was probably like my 5th largest, now my 9th largest. Not a good time to be a Telus shareholders. Of course, you probably know about that, or if you own any other telecoms. I'm at this point where I must monitor the stock quarterly to ensure that cash flow metrics remain stable and trying to see if the investment thesis about generating more cash flow down the road will actually happen. So this one, I'm a bit disappointed, but I am not at the level where I'm willing to pull the trigger yet, just because over the past few quarters, Telus is showing better financial metrics. And because there are improvements, I am willing to hold on to this one a little bit longer. Again, if I'm losing, right now I'm not losing money, but if I'm selling Telus at a poor performance, that's going to suck, but it's not going to kill my portfolio. It's not big enough to kill my portfolio, to hurt it like big time from a return perspective. So I'm willing to continue this one for a little bit longer, but I'm at this point where I must make sure that they will continue to increase their dividend. So last quarter, they were showing a cash payout ratio at 91%. Definitely not ideal. I want to see that going under 90% and then eventually under 80%. So we'll see if the thesis is right or wrong. And in 25, I'll likely make a move. So it's still has a lot of great value, highly rated at DSR because of that, because if they are able to finally turn things around, this one is going to generate a lot of money going down the road. So we'll see how it goes. Patient is always your ally. And yeah, so don't be trigger happy when you review your portfolio. The key is to be well diversified. So if I'm getting hurt by one of my largest holdings and 9 of my top 10 are doing well, I don't have to care that much, right? So, right, Moose, I extended a little bit because I had a lot of things to say today, but I hope that I've given you a little bit more perspective on how to sell your favorite stocks. Tomorrow, we are talking about a stock that is very frustrating to hold, and it's Granite. So let's take a look at this one tomorrow, and until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.